66,329.50. A 2.53% explosion. Across trading desks, you can almost hear the celebration. The Nikkei 225 just ripped higher, obliterating every short, and now the retail herd is piling in, convinced this is the beginning of a massive melt-up. But here's the cold truth you won't hear on the headline news. Right now, as we speak, the index is being sucked into a precision trap at 67,067, and the fuse is a Bank of Japan policy shock that the market has completely mispriced. I'm not here to celebrate with you. I'm here to show you where the danger zone sits and where the hidden opportunity actually lies. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow. And if you ignore the first level, you could walk straight into the liquidation freefall that nobody sees coming. Let's get to the instant market verdict. Right now, the session bias is clearly trending. The monthly, weekly, daily, 4-hour, and 1-hour charts all scream strong buy. But that is exactly the problem. When every time frame aligns in one direction, the rubber band is stretched to its limit, and the smart money starts fading the latecomers. The single invalidation level that flips this entire bias from bullish to distribution is not the resistance above. It's the support below. Write this number down. If we get a daily close below 65,155, the 5-day moving average, the entire bullish structure resets. Not a wick. Not an intraday probe, a daily close. That level is the pivot. The herd is positioned overwhelmingly long, with call buying surging and ETF inflows hitting a 3-week high. That means the market is one hawkish surprise away from a violent long squeeze where everyone rushes for the exit at the same time. The liquidity is sitting right below 65,155, and if we break it, the sell stops will accelerate the drop towards 64,474. This is the trap most traders don't see. The stronger the trend, the more painful the reversal when the catalyst finally hits. And that catalyst might already be on the calendar. Let's go into the technical deep dive and I'll show you exactly why 67,067 is the line in the sand. Pull up your weekly chart. The Nikkei has been in a relentless stair-step rally, but what's truly remarkable is the distance from the 200-day moving average. That line is sitting way down at 53,527. When the price is trading more than 12,000 points above its 200-day, you are in an extreme momentum phase that historically does not end with a gentle consolidation. It ends with a violent mean reversion or an absolute exhaustion breakout. Now, pull it down to the daily. The 20-day moving average at 63,029, the 50-day at 60,531, the 100-day at 57,626, they are all sloping up like rocket fins. But look at the angle. The 5-day at 65,155 is practically vertical, and the 10-day at 64,395 is chasing it. When the short-term averages stretch this far from the longer-term ones, the coil is winding. The MACD on the daily shows a reading of 1,797.5, still expanding, so momentum is positive, but the RSI is at 71.2, flirting with overbought territory. That doesn't mean it can't go higher. It absolutely can in a melt-up, but it does mean the risk-reward for fresh longs up here is deteriorating fast. Now drill down to the 4-hour chart, and here's what most traders miss. The price action over the last 3 sessions has carved out a series of higher highs, but the MACD histogram on the 4-hour is starting to flatten. I'm not calling a full negative divergence yet, but the momentum is not accelerating at the same pace as price. That subtle exhaustion is the early whisper that the rally is running on fumes. The immediate support sits at 64,474.52, which aligns with a prior breakout level that now acts as a demand zone. Below that, the next structural floor is 63,210.55. On the resistance side, we have a clean level at 67,067.47, and if that breaks with conviction, the next magnet is 68,331.44. The 60-minute chart shows a tight consolidation just below the 66,500 area, and a 1-hour close above 66,500 would be the trigger for a direct assault on 67,067. But if it rejects that zone and prints a 1-hour bearish engulfing, the trapdoor opens. The hidden divergence on the lower timeframes is the signal the institutions are using to offload into strength. Now, no Nikkei analysis is complete without understanding the cross-asset linkage. This index is not just a Japanese equity story. It is the ultimate carry trade barometer. When the yen weakens, Nikkei soars. When the yen strengthens, Nikkei collapses. Right now, US dollar to Japanese yen is clinging to elevated levels, and that yen weakness is the jet fuel behind this 2.5% surge. But yesterday, an analyst article dropped with a warning that should send a chill down your spine. Why Japan's rate hike could hit crypto and Nvidia at once. The logic is viciously simple. If the Bank of Japan actually hikes rates and signals further normalization, the yen will spike. That instantly unwinds the carry trade where leveraged funds borrowed yen to buy US tech stocks and crypto. The liquidation of those positions would cascade directly into Nikkei as foreign investors dump Japanese equities to repatriate capital. So the very news that sounds bullish for the economy, a rate hike, can become the detonator for a Nikkei meltdown. This is why we are at a pivot. The 24-hour news says Japan stocks higher at close of trade, Nikkei up 2.53%. That is the rearview mirror. The forward-looking risk is the BOJ speaker or the next policy hint. If they sound hawkish, the 67,067 level becomes a ceiling, not a launchpad. MY 1 to 2 week directional lean is cautiously bullish but with a violent reversal risk precisely at resistance. I think we test 67,067, maybe pierce it slightly to trigger the breakout chasers, and then we see if the real money sells into it. The event that invalidates this view completely is a daily close above 67,067. With volume expanding. That would signal the melt-up is real and the index targets 68,331 and beyond. Conversely, a daily close below 65,155 turns the trend bearish for the first time in weeks. So, do you think the Nikkei breaks 67,067 this week? Comment breakout or reversal right now. I'm tracking the consensus live. Now we are at the section most people skip, and that's exactly where the money is made. Keep watching because I'm about to hand you 3 precise trade plans, each with exact entry, stop, and targets, and I want you to screenshot the on-screen overlays. This is not theory. This is actionable. And I'll start with the conservative sniper approach for those who want to let the trade come to them. Strategy 1, the sniper. This is a conservative, pullback-based long designed to exploit the strong trend without chasing. The entry condition is a limit by order at 65,155, which is the daily 5-period moving average. That moving average has been the accelerator pedal throughout this rally, and a pullback to it represents a high probability reset. You wait for price to tag that level and look for a 4-hour bullish pin bar or a strong hammer confirmation before committing. The stop loss goes at 64,450, just beneath the key support of 64,474.52. This gives the trade room to breathe without exposing you to a full structure break. The first take profit is 66,800, just under the consolidation high. The second take profit is 67,050, right at the doorstep of the 67,067. Resistance. The risk to reward on this setup is a clean 1 to 2.8. The entire plan is invalidated if we get a daily close below 64,200, because that would break the higher low sequence and signal a deeper correction. So you enter, you set your stop, you walk away. This is how snipers operate. On-screen overlay for strategy 1, the sniper, conservative, entry, 65,155, limit, with 4H bullish close, stop loss, 64,450 take profit 1, 66,800 take profit 2, 67,050 risk, reward, 1:2.8 hour invalidation, void if daily close below 64,200. Type your Nikkei range for tomorrow in the comments now. Let's see who's aligned with the sniper zone. Strategy 2, the active trader. This is the standard play for those who want to ride the momentum breakout but with a confirmation filter. Here, you don't buy blindly. You wait for a 1-hour candle close above 66,500. That level is the immediate glass ceiling. Once we get that close, you do not chase. You wait for a 15-minute pullback to retest 66,500 as new support, looking for a small-botted candle or a micro double bottom. Your entry is at 66,500 on that retest. The stop loss sits at 66,100, below the recent swing low that formed before the breakout. This gives you a tight, logical invalidation point that says the breakout failed. First take profit is 67,067, which aligns with the major resistance. Second take profit extends to 68,330, the next structural magnet. Once target 1 is hit, you immediately move your stop to break even and trail it by the 1. Our 10-period moving average, locking in gains while letting the melt-up run. This strategy thrives on the very breakout that the herd is praying for, but it gives you a disciplined entry so you are not the exit liquidity for the trap. The setup is void if a 4-hour candle closes back below 66,000, because that signals the breakout was a fakeout and the bears have seized controlled on-screen overlay for strategy 2. The active trader, standard, entry, 66,500, 15-minute retest after 1-hour close above, stop loss, 66,100 take profit 1, 67,067 take profit 2, 68,330 trailing stop, to BE after TP1, then 1 HMA10 invalidation, void if 4H close below 66,000 now for the aggressor. This is a high-risk, counter-trend fade designed exclusively for those who can lose small and manage risk with zero emotion. The logic here is to sell directly into the melt-up at the 67,067 resistance, anticipating the trap. You set a sell limit order at 67,067. You need to see a clear 1-hour bearish rejection candle, a shooting star or a bearish engulfing, before the fill. If it just slices through, you stay flat. The stop loss is placed at 67,350, above the resistance cluster and beyond the usual stop hunt territory. This gives a tight stop of about 28 points. First take profit is 65,800, which is a quick scalp into the gap. Second take profit is 65,155, the sniper support. The risk to reward on this is roughly 1 to 3, but you must accept that counter-trend trades have a lower win rate. The invalidation is a 4-hour. Close above 67,150, which signals the breakout is real and you are wrong. Get out immediately. I only recommend this play for traders who size it at half their normal risk and are prepared to be stopped out swiftly if the melt-up continues. This is not a conviction trade. It is a probabilistic fade at an exhaustion point. Strategy 3, the aggressor, high risk, entry, 67,067, sell limit, 1H bearish rejection required, stop loss, 67,350 take profit 1, 65,800 take profit 2, 65,155 risk, reward, 1:3.0 R invalidation, void if 4H close above 67,150 risk management pulse. This cannot be optional. Never risk more than 1 to 2% of your account on any single trade. No position should be held through high-impact Bank of Japan speakers or unscheduled yen intervention headlines. Stops are non-negotiable. A stop is not a suggestion. It is the line that keeps you alive for the next trade. The Nikkei can gap 300 points on a yen spike. Protect your capital first, profit second. Let's summarize the single most critical level for the next session. It is 67,067 on the upside and 65,155 on the downside. That range is the battlefield. A breakout above with volume opens a path to 68,331. A breakdown below 65,155 on a daily close opens the trapdoor to 64,474 and potentially 63,210. Everything in between is noise and liquidity grabs. Tomorrow's wildcard is the Bank of Japan commentary overnight. Any hawkish shift in language, any mention of ending negative rates sooner, and the yen carry trade. Unwind will slam the Nikkei before you can blink. So watch US dollar to Japanese yen alongside the index. If dollar yen drops 50 pips in seconds, close your longs and switch to sniper mode on the short side. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen and see how the exact same carry trade dynamic is hitting crypto and Nvidia. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one, right before the market moves. This is Alpha Market Meridian. Stay sharp.